A significant amount of academic literature has been written on the investment size factor, analysing the return premium achieved from smaller companies over their larger counterparts. This includes notable studies by the likes of Nobel laureates Eugene Fama and Kenneth French in the 1990s. When we look at long-term data sets of market returns, both prior and post-Fama and French's work, we can see clear, persistent and significant outperformance from small caps, as this segment of the market has consistently grown at a faster rate off its smaller base. There is also evidence that the lower levels of analyst coverage on smaller size businesses can provide a less efficient market with greater price discrepancies and wider valuation dispersion, advantageous to selective stock picking. In today's episode, following an unusually prolonged period of underperformance from smaller companies, we explore the opportunity set in front of one active global manager within this sector. Hello and welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on the topical issues of today. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details of the unique ways in which we do that on our website, killik.com. Today we are joined by Simon Barnard, the lead portfolio manager on the Smithson Investment Trust, ticker SSON. Smithson uses a very similar investment process to that used on the Fundsmith Equity Fund, but focusing on businesses which are smaller in size, typically investing in companies between 500 million and 15 billion pounds in size, measured in terms of market capitalisation at the time of purchase. We recorded a discussion with Terry Smith on the Fundsmith Equity Fund back in episode 3 of our Investor Insights series, and you can listen to this, as well as other episodes, by navigating to the playlist via the Killik Co YouTube channel. Simon joined Fundsmith in September 2017, having previously started his career at Goldman Sachs Asset Management in 2003. Initially cutting his teeth as a research analyst, notably covering areas such as technology and the consumer sector, both highly relevant for the Smithsons strategy, before taking responsibility for a number of Goldman Sachs's fund strategies. On joining Fundsmith, Terry Smith tasked Simon with exploring and devising a complementary strategy to the large cap fund, and subsequently Smithson IPO'd on the London market in the third quarter of 2018. This was an interesting time to speak to Simon, as the Smithson Investment Trust has generally performed well, particularly for investors which initiated positions at launch, but has suffered a more challenging last 2 years, including notable weakness in 2022, as more growth-orientated smaller companies derated in the face of rising interest rates. The unusually prolonged period of underperformance of small caps relative to large caps over recent years, alongside a number of issues which have impacted flow and demand for listed investment companies on the London market, has also been felt in the widening of share price discounts, referring to the difference between the share price and the underlying net asset value, or NAV, of the portfolio. And this has particularly been the case in small cap orientated investment companies. We've been encouraged by the greater number of investment company boards taking action when faced with widening discounts, and Smithson has been one of the more active trusts in terms of the quantum of share buybacks over the last 2 years. We believe an aspect of share buybacks which is perhaps less well understood, or certainly less frequently discussed, is that the action of buying back shares at a notable discount is not simply for the purpose of facilitating exiting shareholders in order to reduce the discount or subdue short-term share price volatility, but is also for the accretive impact of doing so. And therefore, because of this, it should in many cases be viewed as a matter of prudent capital allocation. The ability of an investment company or investment trust to buy back its own shares when they sit on a discount should be viewed alongside the expected prospects of any alternate use for cash or proceeds from realizations. Smithson can be used as a good example of how buybacks can be accretive. The company bought back nearly £160 million worth of shares in the calendar year 2023, equating to a bit under 7% of the total shares in issue. It bought back these shares at an average discount of nearly 11%. This process is accretive to remaining shareholders, enhancing the net asset value, and in 2023, this boost to NAV was around £18 million, equating to over 80% of the company's fees and expenses for the whole year, therefore very meaningful to the compounding of returns going forward. At the time of record, in the third week of April, Smithson shares trade on around a 10% discount to NAV, and as we discussed in the later part of this discussion with Simon, the board remains active in buying back shares. Hi Simon, thank you for joining us today. How are you doing today?
Thanks, Gordon. Yeah, very well, thank you. Thank you for having me on.
No problem at all. Yeah, so the first question we ask as a kind of standard opener to these discussions attempts to get a bit of an insight into your kind of typical working week or what you've been working on recently. So I wondered, would there be any kind of interesting anecdotes that you could share from whether it's just a company meeting or just an interesting thing that you've read recently? We've had kind of book recommendations in this or articles highlighted. Anything that you could share there?
Well, it's funny you say that in terms of interesting. You have to bear in mind that our week can be considered very boring. In fact, the famous bond investor Howard Marks always used to say that being an investor is a lot like being an airline pilot. It's hours of boredom punctuated by moments of terror. And not quite like that. So our week generally is spent at our desk reading. We do a lot of reading and some writing. So it is also quite seasonal because as we go through earnings season, where it happens quarterly for most of our companies, it's all hands on deck because we write those up in great detail and analyze them to spot clues for which way the companies are heading. And that takes up a lot of time every quarter. And outside of that, of course, we're researching new companies. And in general, we'd have probably one management meeting a week. So we had a lot of interesting anecdotes from those. But in terms of reading, I'm always reading investment-related books. And probably the last one I read recently was Reminiscences of a Stock Operator, which is based on the life of Jesse Livermore, which is a fascinating story. It's not completely comparable to what we're doing because obviously Jesse was a short-term speculator, but there are a few nuggets of gold in there, but I think anyone in the industry would find it interesting. And then maybe a slightly less investment-related book, which I'm reading at the moment. I say reading, I do a lot of listening on Audible during my commute, but is a book called 4,000 Weeks by Oliver Burkeman. So it's really focused on productivity. He calls himself a productivity geek, so it's for all of those who are trying to fit more into their day. But actually his conclusion is, you just have to accept that you can't do everything. We're all busy people, and there are so many things that have to be done that simply won't get done, and you've got to learn to accept that. So it's part psychology and part practical.
Oh, good stuff. Yeah, not heard of 4,000 Weeks, or I'll check that out. But yeah, and I completely agree. I'm consuming much more of my reading via my ears for things like Audible. So I'm exactly the same. But yeah, no, thank you for that. So maybe let's move on to the strategy itself. So obviously Smithson kind of sitting alongside the kind of Fundsmith Equity strategy and doing quite a similar, very similar approach, but obviously kind of looking at that kind of subset down in terms of company size or market cap. And if we kind of look back at the last kind of couple of years, really, it's very much been characterized by the dominance of those very largest businesses generally kind of driving the market higher at the expense of kind of weaker returns from mid and subsequently smaller cap businesses as well. I wouldn't mind kind of hearing your view or your take on that. I mean, do you consider the kind of reasons for that to be kind of entirely cyclical, or were there kind of structural issues at play here as well?
I think they're cyclical. So if you look at the history of it, I mean, over the last 25 years, small and mid cap has significantly outperformed large caps. And it's only in the last couple of years, and I think notably when interest rate expectations started increasing around the start of 2022, that small caps notably started underperforming large caps. And then I think you've got a couple of other factors such as AI which is really driving the large caps much more than the small caps. And that very large companies that you mentioned are pretty much all being driven by AI at the moment. And so if you look at valuations where we find ourselves today, funnily enough, valuations of small cap relative to large cap are down to levels that we haven't seen since around 2000, which is somewhat ironic because, a lot of people are comparing the current craze around AI to that of the dot-com era boom. Now, personally, I don't think it's anywhere near that level of hype. But it is interesting that once the dot-com bubble did burst, and during that period, you did see large caps outperforming small caps. But once that was over, then, of course, we know small caps outperformed for the next 2 decades. So for our perspective, we're quite optimistic, bearing in mind that we find ourselves at a relatively extreme valuation discount for small caps relative to large caps, and a reason that we think we understand both around the AI, but mostly around the interest rate environment. And hopefully, if interest rate expectations have peaked or are soon to peak, then that will relieve a lot of the relative pressure on small caps versus large caps.
Yeah, some really good points there. We certainly agree with the kind of cyclical view that small caps will, in time, return to that long-term trend of outperformance, and certainly that will provide a kind of tailwind to this portfolio. And so Smithson published its own annual results back, I think, at the end of February in Q1, and you kindly provided, as you regularly do, a kind of update meeting to the research team here. And one of the things that came out of that meeting was you describing a kind of subtle alteration to the process of uncovering new prospective holdings for the portfolio. And I wondered if you could maybe describe kind of how and why you've enacted that change.
Yes, well, the reason we've done it is because performance has been good over the 5 years since inception. We've had 4 up years, which have outperformed the index, and only 1 down year that's also underperformed the index. But, by our account, that down year was poor, and we therefore wanted to make sure that we were covering all our bases in the future, make sure such a year didn't happen again to that level. So we have slightly adjusted where we look for companies, but we have in no way changed the process or the strategy. So the companies we look for still have to meet our very strict criteria. It's just that we started looking for them in different places. So historically, we had been using a financial screen, using metrics such as return on invested capital, margin, and growth. And we realized that after 5 years of using this, it was tending to throw up the same companies, even in the very large, small and mid-cap space. And we realized, therefore, that given there are so many thousands of companies in small and mid-caps, there must be, therefore, many hundreds that we're missing. For one reason or another, you can never quite always explain why some things are left out of screens. So we decided to scrap the screen, basically, and look at pretty much every company in our index and beyond, which meant, obviously, a much higher level of research input in terms of names looked at. But after this level of amount of time that we've been operating, clearly, it takes us almost no time at all to decide whether a company we're looking at is worth further exploration or not. And I mean, typically 2 minutes or less. So even though we're now suddenly looking at hundreds more companies, it's 1, actually quite fun, and 2, not that laborious, because, you can very, very quickly discount the companies you're looking at. And on the flip side, we found quite a few diamonds in the roughs, some of which have percolated their way into the portfolio now. So it has been a very fruitful exercise. And it's just meant that we have been able to scour different parts of the market that perhaps weren't showing up in our screens before, and therefore allowing us to find and own very different business types to those that we've owned before, even though those businesses still meet our very strict criteria.
No, thank you for that. And you mentioned a few new additions to the portfolio recently. I wondered, slightly in a follow-up to the last question, if you can maybe describe the rationale behind some of those new holdings. in a couple that kind of sprung up to me was Exponent and Oddity as perhaps having slightly different characteristics to what we've seen from a kind of typical constituent Smithson portfolio holding that's gone before. Could you maybe kind of run through the rationale behind those two?
You're right. And they're very good examples of the overarching theme, which is that we're looking for different types of businesses to add a level of diversification to the fund. But individually, these businesses are still small, fast growing and exciting, which means that we don't have to give up any potential future performance for that benefit of added diversification. And so perhaps if I talk about Oddity first, this is a direct-to-consumer, online-only cosmetics company. And now cosmetics is an area that Fundsmith likes very much, but not something that we've yet been able to own in Smithson because obviously the best known names are all very large. But Oddity is very different because they are focused really as a data company initially, which have now turned that into a consumer and cosmetics company. And the way they've done that is that they've trained AI algorithms to be able to take consumer data. So when they get a new customer, they ask for about 40 or 50 data points in a process which they call a quiz. I've taken it. It's not quite as painful as it sounds. And using those 40 or 50 data points, including sometimes a selfie picture as well, they can recommend products with a very close match to that consumer's skin type, consistency and color desired. And what's interesting is that the very large players in the industry, L'Oreal, Estée Lauder, have really ignored a lot of the online market, particularly to new customers, because as you might imagine, it is hard selling cosmetics online to new customers because most people want to try and pull the product before they buy it. And the big danger, of course, with cosmetics is returns. Once a cosmetic product is returned, you have to throw it away. So it's very expensive to be sending out products and then accepting returns if the customer doesn't like it. So that is a good reason for these companies to ignore that channel. Obviously, refills are no problem. Once a customer knows what they want, it's very easy for them to go onto L'Oreal's website and reorder. That's not difficult at all. But therefore, the channel that we know that they prefer is the bricks and mortar channel. And so you tend to walk into a Boots or a Sephora and have a beauty expert, in inverted commas, try to help you choose the right product for your skin type and also educate you on how to use it at home. Now, what's interesting to us is that over time, Oddity have been able to tweak their AI algorithms so that they are now achieving a 90% match for their customers first time with their products, all done over the online channel with the data collection as I outlined. And they know that from their return levels, whereas the in-person beauty experts are actually only achieving an 80% match judged by their return levels. So funnily enough, currently the machines are winning. Now, I'm sure that L'Oreal and Estée Lauder will cotton onto this at some point, but given their lead in data collection, especially, we think Oddity are years ahead. To put that into context, L'Oreal told us recently that they now have data on over 10,000 consumers. Oddity, in their latest update, told me that they have data on over 40 million consumers and 2 billion data points. And that is why their AI algorithms are proving so effective. And then going on to Exponent, this is another fast-growing company. I should have said that Oddity grew, as you might imagine, 50% last year and is growing another 20-30% this year in such a wide space for them. Exponent is a little more sedate, growing high single-digit, low double-digit. But this, again, is a complete departure for Smithson, being a consultancy business. But it's a very different type of consultancy business. So it was founded in the 60s, initially called Failure Associates, and it was designed to focus on very technical areas to do with disasters. So, for example, they did work into the World Trade Tower collapse and into several oil spills, or also into the Challenger shuttle explosion. So they were basically a collection of PhD scientists that were brought in to investigate very difficult situations. Now, the company has expanded a lot over time, but now is the largest collection of PhD scientists for this commercial purpose of over 1,000 people. And increasingly, they are brought in by companies either defending themselves against litigation for product failure, or for companies bringing them in to see what might happen negatively to their products before launch. So, for example, they're doing a lot of project work on automatic driving systems, autonomous driving, so that they know or can investigate what could possibly go wrong with the autonomous driving before it is fully rolled out. So we got a very good opportunity to buy this company because over the last 50 years, it has actually been a very stable grower. It's got fantastic mid-20s EBIT margins, around 40% return on invested capital. So great metrics, but we got our opportunity because, like most consultancy businesses, they are driven by their headcount in terms of revenue growth. And with PhD scientists, it's not always easy to get hold of new headcount. And so they tend to take them when they can get them. And over the last year or so, they have been hiring more aggressively because those people have become more available. Whereas as the economy has softened, they've had slightly less demand for their services. So we've seen their consultancy usage rate drop from the low 70% to the high 60s. The stock market didn't like that, but it gave us our opportunity to enter because, of course, we know having more headcount is a positive for the future. So we took advantage of that dip in the share price.
You can certainly see how both those businesses kind of add something a bit different to the portfolio, but still have those characteristics that you're looking for. Yeah, thank you for that. In your kind of periodic updates, you'll regularly give those kind of aggregate statistics of the portfolio in terms of the kind of quality, those kind of return on invested capital figures. I wondered if you could kind of run us through where the portfolio currently sits on those kind of quality numbers, and also crucially on the valuation side. Can you kind of run us through where we're sitting at the moment at an aggregate level?
So interestingly, after the changes that we've made by adding these different types of businesses, our headline quality metrics have actually ticked up for the average portfolio. So on return on invested capital last year, our portfolio averaged, or the companies were averaging 43%. This year it is 59%, although I should highlight that one of our companies called VeriSign has a very high return on invested capital and tends to skew the number a little bit. So if we exclude that, the current return on invested capital average for our companies is 26%, but also still higher than it was excluding VeriSign last year. And, we always compare this to the index because that makes it more meaningful. And the index on average, the companies within that are generating around the 10% return on invested capital. So our companies are far superior to the index. And operating profit margin is 24% on average for our companies. That's about the same as last year. Last year was 25%. But again, compared to the index at 6%, it is much, much better. And looking at valuation, this has obviously changed somewhat over time. We, publish our valuation metrics since inception in 2018. And you can see that the changes that we've seen right up to the peak of 2021, the valuations, we look at free cash flow yield, got down to a 2% free cash flow yield by the end of 2021. That genuinely was feeling a bit expensive. And it's got all the way down to the mid 3% by the end of 2022. Today, we see ourselves not far off that, probably around 3%. The number we published is about 2.5%, but that's a very backward-looking number. And for various reasons, free cash flow for our companies was a little weaker in those backward-looking numbers because they were rebuilding their working capital and investing cash into that. And so if we took more up-to-date numbers, we've very recently published, then that free cash flow yield is back to around 3%. We also had a couple of companies over the last 12 to 18 months that were not producing free cash flow back then, but are today. If we adjusted for those, actually, the free cash flow yield for the portfolio would be back above 3%. So we feel that valuations, as we were talking about earlier, are looking much more attractive these days. And just anecdotally, we feel that we are surrounded by opportunities. You can see that by the action that we've taken over the last 6 to 12 months and the companies we've added. And to be honest, I think we're likely to add a couple more in the near future because of the opportunities we see. But you compare that anecdotally to what we were doing in 2021. And by the end of that year, it was really a struggle to be finding new ideas. Whereas today, dare I say, we almost have more ideas than capital. So it really does feel like a better operating environment.
Thank you for that. I mean, one thing with the Smithsons, obviously a London-listed investment trust, and one thing that's got a lot of attention at the moment, quite rightly, is capital allocation and addressing discounts. So we've seen discount widening kind of prevalent across the whole investment trust sector, really, and Smithson's been no different to that. It suffered from those from that kind of weakening sentiment, some of which is kind of structural issues within the investment trust sector itself. But I just wondered if you could detail kind of how yourselves and the board of Smithson are approaching discount control at the moment.
You're right. It really has affected the whole sector, and it's exactly correct that shareholders should be very focused on this. Interestingly, when we look at the data, the discount levels that were reached in 2023 actually surpassed those that we saw in 2008 financial crisis. So, it's just another indicator of the bear market that we were in up until the end of last year. But the board have been proactive in addressing this, and they started the discount policy, which is share buybacks, around the middle of 2022. That has continued, but actually has stepped up of late. So I've been privy to several board meetings where they've been discussing this, and they have become a lot more aggressive with share buybacks all the time, that the discount is at a double-digit level. And I have observed that over the last few months. So it's good to see that they're addressing this, and I'm sure that they will be able to speak more about that at the upcoming AGM.
Our kind of standard final question is hopefully not the trickiest one of the set, but it asks you to kind of to describe your highest conviction area at the moment, and maybe that's a single company, or maybe it's a kind of an area of the portfolio. But I wondered if there was something that you'd highlight as being kind of a particularly positive attitude towards at the moment.
Funny enough, right now, I mean, we're seeing so many opportunities from US technology to Japanese healthcare. It's hard to pick one, but if I had to pick a single stock, it is actually one we've already discussed, Oddity. We're very excited about this. Not only is it different for us, but and growing quickly, but it's, funnily enough, also at an extremely reasonable valuation at 3% free cash flow yield, which, as you now know, is roughly in line with the overall fund. So we're very optimistic about that individual name. But other than that, we've had such a downdraft in small and mid cap over the last 2 years. I think, hopefully, that we can be optimistic about the space in general.
Yes, it certainly does appear like there were a number of factors combining here to suggest returns from global small and mid caps could be compelling from here for a patient investor, whether it be through generally lower valuations across the board, which we discussed earlier, particularly relative to large cap, evidenced by the opportunities such as Oddity as you described, but also coupled with the discounts in the shares of listed small and mid cap focused investment trusts. Simon, thanks so much for your time. It's always good to chat. Thanks again.
It's been a pleasure.
Thank you for listening to the Investor Insights podcast. You can contact info@killik.com, referencing the podcast for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.